I wanted to start with Drew Monroe, our president, and one of our founders is here, and I wanted him to talk a little bit about who Prosper is. And, Drew's a former EO guy himself, so I know EO has been incredibly important in our company, and we're going to let him talk a little bit about that. Then we'll get into the material, and that shouldn't take too long for us. And then in the end, I wanted to open it up to questions, not just questions about the material that we're going to go through today, but also any questions that you have about what's going out there. I get a lot of questions about, pandemic coverage, or, what are the potential lawsuits I'm looking at for my business as we reopen, and what kind of guidelines should I be following? So the end, we'll just kind of open it up to any questions that you guys may have. If you want, go ahead and text those questions into the feed, or at the end, just let Christina know that you have a question and we can unmute you and get you on there to ask whatever's on your mind. But without further ado, we'll let Drew kind of get the ball rolling and introduce us.
Yeah, I want to say thanks for having us, and thanks for everyone that showed up. I know a lot of you, I recognize some of the names, and for those of you that don't know, I was in EO for a few years, and it was during a really crucial moment in my business. In the last 3 years, have moved from 15 to about 100 employees now, and couldn't have done it, I think, as effectively or keeping my sanity without having a really strong forum group. And so totally get the value and the companionship that EO has to offer, and I just think it's a great thing, and I think it just says a lot about probably your businesses, the fact that you guys are in here. So not supposed to be a big commercial for us, but we are definitely one of the fastest, if not the fastest, and probably definitely the fastest growing organic insurance agency in Virginia. We are also pretty much the highest rated. We've got over, I think we're right at about 1,000 5-star reviews on Google. We track our Net Promoter Score, and I won't go through the details of what drives that score, but we are more than twice the industry average. We have a higher Net Promoter Score than Apple, Amazon, USAA, pick your benchmarker. We're obsessed about giving really good service and really driving a product that differentiates us from our competition. So Ryan runs our commercial division. He's awesome, and I have 100% confidence in him. I think we do a lot of really unique things, and we really try to approach this differently. Just like the rest of my business, I want to think about how we can drive value that other companies can't, either don't have the resources or don't care enough to. So that's been our secret to success, and I really appreciate you all taking the time to listen to a few tips from Ryan. So thanks a lot for having us.
Thank you, Drew. All right, so basically we just got 5 quick points that we're trying to arm you with as business owners to really better negotiate your standing when it comes to your commercial insurance coverage and your commercial insurance pricing. And we're going to talk about carriers in particular throughout this, but I just want to say before we really get started that this is not a statement that one particular carrier is better than another particular carrier. What I have found in my career of about a decade of insurance in the commercial space is that really most of it has to do with the particular agent and how they've structured that policy for you, far more than it does for the individual carrier. So when you hear us say, Travelers or Nationwide or any of these other carriers, it's not so much that one carrier is awesome and every other carrier isn't. It more has to do with how that policy is being set up, which actually kind of dovetails nicely into our first point. So our first tip here is that most insurance carriers are made of many underwriting companies. So as a business owner, if I went to you and I said, hey, who is your commercial insurance through? You may come back and tell me that my coverage is through Travelers, right? And that's great. My next question would be to you, okay, which Travelers are you with? Are you with the Travelers Indemnity Company? Or are you with the Travelers Indemnity Company of Connecticut? Or are you with the Travelers Indemnity Company of America? Or are you with any of these number of underwriting companies that compose the entire corporate carrier of Travelers Insurance? So there's a number of reasons why insurance companies do this. The one that stands out for you as a customer and a purchaser of insurance is that insurance rates are filed with the state. Every state that an admitted carrier operates in, they're going to file rates with. When they have multiple underwriting companies, they can file different rate structures. So we'll get into this a little bit more as we go on, but the actual underwriting company is a heck of a lot more important than the broad carrier that you're with. So that leads us right into point number 2. When you evaluate on who you're with, you really want to focus on that underwriting company, not the carrier itself. So we're going to talk a little bit about workers' comp. Workers' comp is great from a theory concept because it's one of the most highly regulated coverages, which makes it a little bit easier to understand than some of the other liability, professional liability, cyber policies that are out there for you. But, you know, we're picking on travelers right now, so let's continue with that theme. On the left side of the screen, you're going to see a number of different underwriting companies for travelers. And on the right side of the screen, you're going to see a number. Now, I don't want to spend too much time talking to you about how the watch works because as business owners, really what you care about is what time it is. But in a nutshell, that number on the right side is what's called a lost cost multiplier, an LCM. And the lower that number is, the better. So when you say that you're with travelers, if you're with the standard fire insurance company at a 1.86, that's going to be a heck of a lot different pricing structure on your workers' comp than the Charter Oak Fire Insurance Company at a 1.14. So I thought I'd bring in a couple examples of how that looks for some of the customers that we've worked with. So in this particular instance, this client happened to be with an underwriting company of American Interstate Insurance Company, which their current rate of a 1.7 was yielding about $60,000 in premium that they were paying every year. But by moving underwriting companies for this particular client, we were able to get them down to that 1.2 LCM, which saved them about $15,000 a year. So that underwriting company in this situation made a huge difference on what they're paying. Now, I know what you're thinking. You're thinking, okay, that's great for companies that pay $60,000 in workers' comp. You know, I'm mainly a white collar firm. You know, when it comes to our insurance, we might not pay 60 grand. Well, here's another example. So this particular client happened to be with Nationwide at a higher LCM of a 1.188, and they were paying about $7,500 a year. And then we were able to set them up with a different company, Employers Preferred Insurance, at a 1.12. So in this situation, that underwriting company actually saved this client about $4,000, which meant a lot to their bottom line. But what's really interesting in this situation is we talked a little bit about underwriting companies and how important they are. Think of how differently this situation would have played out were that client with Nationwide's best paper at a 1.12 and were we with Employers' worst paper at a 1.64. So just to kind of illustrate the point, it's not so much the fact that Employers is better than Nationwide. That's not the fact at all. It's the fact that Employers Preferred Insurance Company is better than the Nationwide Mutual Insurance Company from a rate perspective. So when I talk to you guys about which insurance company you're with, that's why we're hammering the underwriting company, because it really can make a big difference on your policy. Next thing, beware of flat renewals. So I was having a conversation with a prospective client a couple days ago, and I was saying, you know, are you interested in taking a quote this year? And his response to me was, you know what? Honestly, our renewal's flat this year, which, you know, we're pretty happy about. We've been with the same company for a number of years, so we're not going to shop it. Now, when I hear that, there's a couple things that are going on in my head with that flat renewal. The first thing is the state of Virginia dropped workers' comp rates 10% this year, base rates. So if your workers' comp didn't drop 10%, the underwriting company that you're with took 10% addition on top of your rate. So while technically the price may be the same, you are losing that 10% that you should be. The second thing is that we're in the middle of a pandemic right now, and there's a number of factors that are going on with your business. So is your payroll constant? Is it the same as it was last year? How about your total sales? All of these different items add up to measure the cost of your insurance. So while it's really easy for us to look at what am I paying this year versus what am I paying last year, just know that when sales are down and payroll's down and when base rates take a cut, insurance companies love to keep you flat, even though you could be getting a better deal. So when you look at it, there's a couple different things that I want you to look at when you think about how competitive is your price. The first is what we just talked about, exposure. You know, did you add multiple vehicles this year? Did you drop several vehicles? Is your payroll up? Is your payroll down? How about your gross sales? All of these different items can really swing your insurance premiums one way or the other. The second is what's going on with base rates and what's going on with the industry. Just kind of talking about how workers' comp just took a 10% dive. If you're not seeing those rates, the insurance company is holding some money back on you. The third thing is underwriting company that we kind of talked about earlier. Did you stay with the same underwriting company that you were with last year, or did you move to a worse one or a better one? Your proposal is probably still going to say Travelers or Employers or Nationwide. The question is, what actual underwriting company have they put you with? And then finally, how hard is your agent working to negotiate credits for you? So the first three are kind of fixed, right? Exposure and base rates, those are out of your agent's control. Getting you into the best underwriting company and getting you the best credits on top of that, that is absolutely what you pay guys like me for. Fourth thing, agencies make money on finance agreements. Interest rates are negotiable. So if anybody has any wind policies or any excess cyber or excess umbrella or any non-admitted policy that is shown to you with a full annual premium up front, typically what we all do as agents is we'll bring back an option for you that allows you to finance that policy so that you don't have to pay the full annual premium up front. But it's important to know that there is an interest rate associated with that, and that interest rate is by no means set in stone. The second thing is that as agencies continue to grow and get bigger and bigger and bigger, there's an incentive for agencies to make money on the back end based on the financing agreements as well. So I pulled together a couple examples for you guys to kind of check out here. Now here's one. This is a larger policy. This guy's paying about 65 grand a year, and his interest rate is staying at roughly 9.5%. So that's running him an additional $22.83 on his bottom line for what he pays for insurance. It's probably not something that he's registering or she's registering as an additional driver of cost. Is 9.5 the best rate that they could get on that finance agreement? I don't know. That's definitely something that I would be talking to your agent about. Here's another one. Now we're up to 10.5%. Now it's a little bit smaller policy, so the finance charges aren't quite as bad from a line item, but 10.5% interest, that's starting to seem high. Check out this one, 13.8%. You got to be kidding me. I mean, when is 13.8% interest rate acceptable in any other facet of your business? So again, man, as you look at your total premiums and you look at how much you're spending, don't forget about the finance costs if you have finance policies, and try to negotiate that down. And then the final thing is, I see this happen all the time. Remember, you are the buyer. You set the rules. So Drew and I have been meeting with one of his buddies who has a fairly large business that has just been decimated by COVID, right? So payroll is down. He's doing mass layoffs to stay above float. Total sales are basically half of what they were this time last year. It's an incredibly difficult situation for him to be operating in right now. And so he had his renewal back in July, August timeframe, and his agent showed up 4 days before renewal with basically a flat renewal. Now, I talked with this business owner before, and he knows to look out for these flat renewals, so this already pegged as something that maybe not quite right in his head. So immediately he gets on the phone with Drew and I, and he's going, all right, guys, I feel like this is wrong. What can you do about it? And the truth is, for a business that complex, with 4 days lead time, there's very little that we can do in that situation because it takes time to put together these policies and do it right. And the only reason that agent brought that renewal offer to this business owner 4 days in advance is because the business owner let him do it. So just remember that, you guys are in control of the buying situation. There's a couple things you can help do that. The first thing is that you can set deadlines up front for sales guys that you're dealing with, right? If you want your policies 30 days out, make sure that that's understood with a rep and that they need to get you those policies 30 days out. The second time is, how many times have you been in this situation where the agent 2 weeks out, 3 weeks out brings you a price, then a week later that price drops, then a week later that price drops again, then at the 11th hour of the 11th day, at the absolute last minute, finally that best price comes out, right? That's just an annoying way to do business, going back and forth like that. And the final thing is, really it comes down to this, right? If you run a business and you have salespeople, the best way to drive performance of your salespeople is to hold them accountable. So it's amazing to me how many business owners don't hold the salespeople that they buy from accountable. So if you really want to change some of these things that annoy people, set those deadlines up front. Tell your agent that policies or proposals are due 30 days out. Shop it with all their agents. And if your agent doesn't show up with a quote 30 days out, they miss the deadline. I promise you, if you do that once with that agent, they will never miss another deadline for you again. Second is require the best pricing up front, right? So say that, hey man, when you come in with your numbers, I really do need your best number up front. we're not going to be able to go back and negotiate for that on the back end. So make sure the insurance company brings me your absolute best price up front. And then if they get beat out by somebody and they come back after the fact and say, you know what, instead of doing it for 19, I can actually do it for 15, which is 500 less. Buy from the guy who's at 1600 or whatever. Teach the agents a lesson and hold them accountable. The reason that agents do this is because statistically, the person that's last in and is the last person to meet with you earns the sale 90% of the time. So as salespeople, you know, we're commission based. It's important that we do things right, but at the end of the day, we need paychecks. So if you let salespeople, especially insurance salespeople, if you let them come in at the last minute, 90% of the time they absolutely will. So you have to change that on the front end. So again, the idea with this was just to give you a couple quick 5 pointers that hopefully you could bring into your business and help drive some value. Just to quickly recap, those are: one, that insurance companies are made of many underwriting companies, so that you're with Travelers or that you're with Nationwide isn't nearly as important as which underwriting company you're actually with. A second is pay attention to who that underwriting company is. And if it changes or if it moves around, that's a conversation you should be having with your agent. Third, beware of those flat renewals. You know, there are all kinds of things that are going on in the market. And I tell you, insurance never seems to drop unless you shop. So that's a conversation that you should be having with your agent. Fourth, negotiate those interest rates. Make sure that you're getting a fair, square deal on that. And then 5, remember, you're the buyer. You set the rules. You control how you want all this to go. Hold salespeople accountable in whatever facet of your life it is, and I promise you they'll perform better. So that's my quick and 5 dirty question, or my quick 5 tips to help you out in your business when it comes to insurance. Does anybody have any questions about what we went through or what else you guys are experiencing in the marketplace today?
Ryan, Todd Todd and Eric have questions in the chat.
Great. Okay. So I'm not.
Are you able to see those?
I'm not. Can you just read them off for me, Christina?
Sure. Todd wants to know, Todd would like for you to talk about COVID general pandemic insurance coverage and options.
Yep. So I get this all the time. So the way that insurance works, right, is it's essentially a risk pool, and you're trying to add a bunch of money to a pool where some people within that pool will be affected by something, but most will not. That's how we pool risk. That's how we price for it. The problem with pandemics is that everybody is affected across the entire world. So you have a situation where, you know, you have everybody potentially turning in a claim. So I have seen some pandemic insurance coverages come out. Those coverages are typically through the excess markets. And anytime you're in the excess market, you have to be really careful with what you're buying. And I have not seen pandemic coverage that is priced in a way that makes it a smart move for businesses to consider purchasing. And I have not seen coverage that makes it that makes me confident that that coverage would actually pay out. So again, this is something brand new. Companies aren't dumb. They're definitely hopping on, you know, this theory of, oh my gosh, I'm really worried about pandemic. What can I buy? What can I buy? What can I buy? I would say, as a buyer, be careful. Be careful, because the situation is not something that typically is handled by insurance. That being said, if something does come out that we feel good about, that's 100% something we'll be bringing to EO. I just would hate to say something that doesn't actually work. What else you got for me, Christina?
Okay, the next question we have is from Eric Olson, and he says, I've never seen finance charges listed on a policy. Maybe I'm just not looking close enough. Are they listed on most policies by default, or do we have to ask for them?
Eric, that's a great question. Thank you so much for bringing that up. So there's a couple different parts to that. If you're buying from an admitted carrier with a in-state policy, most times those policies do not have finance agreements. So if you're buying from Travelers or from Hartford or from Nationwide or any of these other companies that maybe you've seen advertisements from on television, those are typically admitted carriers that are admitted to do business in the state of Virginia, and they're going to offer you bill plans that do not have finance charges. Where finance charges come into place is the really hard to place type coverages. So if you have an office that's on the water or a building that's on the water, and the admitted carriers are not willing to write wind coverage for you because they're worried about hurricanes, when the admitted carriers fall short of providing a product, you turn to the excess markets. Those excess markets, the coverage is typically not quite as good as what's admitted. And the other big sticking point that most people see is that excess carrier is going to require the full annual premium down up front. So in that situation, a lot of times we'll provide finance agreements because people like to hold on to their cash and they don't want to pay that full annual. And that's fine. Just keep an eye if it's a full annual policy. Keep an eye on it to make sure they're not hosing you on the interest rate. And my thought is, Eric, you probably don't have any excess policies. But if you'd like, we're more than happy to review that with you.
Okay, our next question comes from Jim Weigel. Do all agencies have access to the same underwriters?
No, they do not. They do not. So underwriting carriers, carriers in general, and then particularly underwriters are the people behind the scenes that price things for us. And no, that varies agency to agency. So it really depends on which particular agency you're buying from or working with, and how good their relationship is with their underwriter that works for Travelers or Nationwide or whoever.
Okay, Maria Davalos has requested your contact information. If you look further down in the chat, I've listed Ryan's email address and phone number. The next question comes from Joe. I'm assuming it's Joe Benedetto. How often do you suggest going out to bid to different insurance companies?
Yeah, that's a great question. I would say probably every other year, every 3 years at the most. Where we see the most increases and where we see the people that we can really come in and save a ton of money are people that have been with the same insurance agent and the same carrier for 2 or 3 years, because you get that 2 or 3% increase each year and it just adds up. So I would say there is something to be said for maybe sticking with somebody you're with for a year or two to see if they're treating you fair. But every 3-4 years at the most, you should really be putting that to market just to keep everybody honest.
Okay, our next question comes from John. I'm assuming it's John Hall. Is workers' compensation done through payroll higher rate? What's the best way to avoid an adjustment at the end of the year? And he says that he always updates his employees, but always seems to get an audit.
Yeah, that's a great question. And I tell you, that's one of the easiest ways that we write coverage is we walk into somebody who is just tired of having these surprise $1,000, $2,000, $5,000 bills at the end of the year. So there's a couple different things that you can do to combat that. One of the things that we're seeing is there's been a big push on payroll companies that are trying to get you to integrate and buy their insurance through their payroll platform management system. From an ease of use standpoint, it's very, very easy to do that. It automatically comes out of your payroll. My hesitation on that is what we found from those clients is that the rates for those policies are typically not nearly as good as what can be negotiated by an aggressive agent and a good underwriter. And the second thing is that if you have a claim, especially a sticky claim, the service that you're going to get from those payroll administered plans is not going to be on the same level as from a truly independent agency that has a claims advocacy team to help navigate that for you. So there's a couple different things that the broker world is doing if you're going to stay on that side. One is many carriers these days are offering pay-as-you-go plans. And the way that works is you just have, maybe your bookkeeper or your secretary or somebody at the end of every month goes in and enters what your actual payroll was for that period. And then the insurance company charges you premium for what you actually did during that period. So that way, instead of doing a once a year audit where you firm up the numbers, you can actually do that monthly. And once that bookkeeper does it once or twice, it gets really easy for them. And they tend to do that. And that will avoid any of those surprise audit charges. The other thing that you can do that I do with a lot of my clients, and I have been doing for years, long before this pay-as-you-go came out, was we just sit down 6 months into your policy when pricing's not on the table. And we say, okay, here's what we anticipated on payroll. How much are you actually doing this year? What do you have planned for the next 6 months? Is this something that we need to update now for you? So we split that additional cost of the extra payroll over the next 6 months rather than surprising you with a bill at the end of the year. So there's a number of different strategies that you can help put into place there to get away from that surprise, you owe me $5,000 kind of a situation.
Okay, the next question comes from Eric Olson. Should we shop personal insurance policies, auto, home, every 2 to 3 years as well? And how much does the insurance company or underwriter actually matter? Does it simply come down to which gives better customer service?
So I tell you what, I am, not to toot my own horn, I'm pretty good on the commercial side. I am an idiot on the personal line side. I've been in insurance for a decade. I didn't write my own personal lines policies. I had our experts over here at Prosper do it for me because they understand those markets so much better than I do. Drew, do you want to kind of weigh in on that side?
Sure. Yeah, I mean, I think that similar to what Ryan said, if your situation hasn't changed much, so if you've got the same house, the same vehicles, and your renewal comes in something similar, I probably wouldn't spend too often, maybe every 3 years or so, to hold people accountable. Very similar to Ryan. I mean, I haven't sold a policy in a while, but I spent many years selling a lot of personalized policies, and I would always get excited when someone's said, "Oh, I've been with Geico for 10 years or something," because they play a lot of the same tricks that the commercial lines companies do. So they have different underwriting companies. Geico Indemnity Company will come in and they'll have really cheap rates for a while, and then sign up a bunch of people, and then they'll just go up every single year an amount that's larger than the inflationary amount, and then they'll open up a new company, and then new business policies they'll sell through the new cheap company. So they keep adding the clients, and then they're making money off the clients that they've had for 4, 5, 6, 7 years. I mean, that is like, you can read statements from Warren Buffett's that like says that that's their strategy. It's like very, very, and different companies fluctuate differently. Us being in a coastal area, we do see a little bit more rate fluctuation than you would if you were saying like, I don't know, Kentucky or something like that. But so every few years, but again, prices and everything, if you're going to take the time to shop it and really understand what you're buying, because it's very easy for people to kind of roll some coverages under the rug when they're trying to sell you something. And you know, and think about the value adds too. If you're in EO, you probably have the money and would make you probably don't walk into Best Buy and buy the Dynex. You probably go in and buy the Samsung. And there are some elements of getting what you pay for, and so have conversations about, you know, what is your customer satisfaction rate? Do you have a claims advocacy? If I get in a claim, who's looking out for me and giving me advice and some of that other stuff. $10 a month sounds nice, or $20 or even $50 a month, but you get a really bad claim and you get to a point where you don't feel like someone's looking out for you. You would give all that money back in a snap. I promise you, based on a lot of conversations I've had with people. So every few years, maybe, to keep it honest, if you haven't done it in a while, or you're at a moment in time, you're buying a new house, your kid starts driving or something like that, maybe that's a good time too, because the company that has the best rates for a couple driving an Oldsmobile or something versus someone with young kids, or a house on the bay versus in Chesapeake, or a new house versus an old house, this can be different companies a lot of times. And so that might be a good time to shop too.
Okay, the next question comes from Jim Weigel. If different agencies have access to different underwriters, how do we know if the agency has suitable or the best access to compare rates? First, let's see, for example, a toy importer buying from the origin of a worldwide pandemic, which our country's president doesn't like, and we may go to war with. Do you need me to read that again?
Yeah, if just one more time, I think I got most of Jim's just
Okay.
Get it all.
If different agencies have access to different underwriters, how do we know if the agency has suitable or the best access to compare rates?
Yeah, I mean, I think the easiest way to do that is to shop it, right? So unfortunately, there's no like blanket statement you can do, but what you can do is, if you've been with the same agent and you've been with them for a while now, put it to market. Keep everybody honest. And you know, Jim, there's probably like 20% of the clients I work with where I'll go in and I'll audit their current coverage and we'll put together options, and I'll come back to them. And shoot, I think this just happened with Frank on a personalized policy that we were looking at for him. And it's like, you know what? Your agent's taking really good care of you, and there's not a lot that we can bring to this equation, and that's okay. And in that situation, that business owner knows that, you know what, hey man, I am getting a good rate. The coverage I have is stacking up with what's out there, and I feel good about what I have. And I appreciate Prosper for being honest. Now, that's typically like 20% of the time. If it was 100% of the time, we wouldn't be in this business, right? There are all kinds of things that we find out there regularly. But I would say it never hurts to trust but verify, and you verify by shopping.
I think those are all of the questions.
Cool. Let me just throw one out here that I get from a lot of other groups, and I've been on a couple different podcast meetings with major carriers, and there's a lot of concern among business owners, especially in businesses where they have employees that regularly interact with customers. What do we do during this COVID pandemic, and how do we protect ourselves from future lawsuits? So like if I run a restaurant and I bring in an employee who gets people sick, what am I looking at here, and what should I be doing with my business right now to help protect against that? So I'll tell you, it's very difficult to answer that question with anything concrete, but what the major carriers and what the major insurance lobbyists are trying to push through in recent legislation is they're trying to get safeguards for businesses who do not act with gross negligence in bringing back employees. And the one thing that they keep coming back to is following CDC guidelines. So as a business owner, if you're open and your employees are interacting with customers, I would absolutely make sure that you are following CDC guidelines to the T, because if possible, they're going to pass this next round of legislation and include some protective safeguards for you as business owners to make sure that, everybody under the sun isn't getting sued, but the ones that will get sued and the ones that will stick are, the situations that I've read about. The Journal had a good publication about it a couple weeks ago. But you've got workers at Walmart who go up and tell their boss that they're sick and that they feel like they have a cold, and that employer tells that employee to get back to work. And 3 days later, they're sick with COVID. There's been a COVID breakout, and that employee has died. Those are the type of businesses that are really going to get hammered in this. So as a business owner, I'd say, man, just be careful, follow CDC guidelines, and if anybody's sick, send them home as quickly as possible. And it's a tough line for you guys to be walking right now. Anything else from anybody else? Awesome. Well, hey guys, we really appreciate the opportunity to sit down with you. Thank you so much. If there's anything we can do for you as far as taking a look at your policies, or if you have a question or something like that, my email is right there. I'm available to EO members any time of the day. Just give me a ring, and we'll help shoot you straight.
Ryan, Drew, thanks. That was awesome. Appreciate it.
Thank you.
Thanks a lot
Thanks
for
again,
having us.
guys.